Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, what we've been through in here, 10-year Treasury, amazingly enough, up to 2.61% in here today. Looking at stock markets, just continuing to head downward, and I felt we needed the expert. So I invited Dr. Ed to come in and give us his thoughts in terms of what's happening out there.
Well, Jay, thanks for inviting me to your Good Monday presentation. Welcome, everyone. Jay asked me to comment on what happened last week with the Federal Reserve, and of course all the movement in the bond market and the stock market, Jay, is because of what happened last week. And I think there are two or three factors that everyone listening should keep in mind. First of all, when the vote was taken, Jay, to extend QE3, the $85 billion a month of bond purchases, to extend the pledge of zero interest rates until unemployment hits 6.5% as long as projected inflation doesn't go above 2.5%. When the vote was taken, there was a change. Esther George has voted against the majority from the beginning, from January. This is her fourth dissent. But she got a convert. James Bullard, the St. Louis Federal Reserve chairman, voted with her this time for different reasons. And I think there's probably a half a vote with Jeremy Stein, who's a board member, who's very concerned about the possibility of financial bubbles developing by the very low rate environment. So the first thing to keep in mind, I think, is there's a sense on the committee that is the bond buying getting us the bang for the buck that we need given the cost. So when you do a cost benefit of the buying the bonds, what do you see? Well, you see improvement in housing because you had very low mortgages. You see improvement in commodity prices. You see improvement in the stock market. And you think you see improvement in the unemployment rate. But I want to talk about this a little bit, which is the second point I think everyone should be aware of. The first point is there's dissent on the committee. It's rare to see, it's pretty common to see one person dissent, but it's rare to see two and maybe a half a person dissent. But the second point, takeaway, I think, from the Good Monday report from my end is unemployment, I'd like to ask the question, is unemployment actually better today, Jay, than it was when the recession ended 4 years ago? Well, the answer clearly is yes. At the worst of the recession, we had double-digit unemployment, 10.1. It's currently 7.6. But has the improvement in the unemployment rate been for nefarious reasons and not for more cogent reasons? And I think the answer is yes. For example, the unemployment rate is falling, but mostly because people are leaving the labor force. They're discouraged. They don't want to look anymore. And there's another measure that we may want to talk about. It's called the employment to population ratio. Especially the employment to population ratio of people between 25 and 54, the so-called prime working age. So this is the adult unemployment rate, 25 to 54. Excuse me, the adult employment to population rate. It has been forever 80% in America. So 80% of people between the ages of 25 and 54 typically have a job. When the recession struck, that number fell to 75%. Now it's 4 years later. $3 trillion of bond buying, $3 trillion plus trillion dollars of bond buying, the lowest interest rates ever recorded, zero, practically zero. Tremendous angst and damage to the retired community who are not receiving interest income on their investments. And what do we have to show for it? Do you know what the employment, the population rate today is for the 25 to 54-year-old adults?
You're going to tell me.
76%. It went up one stinking percentage point.
Oh, man.
So was it worth it? Is it worth it? And
you should have just taken $1 trillion and just paid it to
exactly.
the people.
Maybe. So the third takeaway is a mixture of both of them. Should our banking community bankers be worried that their bond portfolio, which I'm sure you're going to be speaking to in a moment, is now the time to take the knife out and start calling the financial experts like you and making some trades? I don't know. I'd certainly want to hear from you about it. But I think two more things have to be kept in mind. One is the damaging effects of the recession with respect to unemployment are not over. Just look around and you can see unemployment all around us.
Well, just comment, Ed, on another that you and I were talking about is the number of people unemployed over 27 weeks.
Yeah, there's some numbers that Jay and I kick around almost every day when we're together, and that is what's the typical number of unemployed people in the American economy at any given moment of our lives? And that number for Jay and our lives, the majority of those months, has been, I'd say, 7 million Americans were unemployed. And of that 7 million Americans, 1 million were unemployed for a long term, sort of like the lost causes, the ones who
just can't
seem to get their life in order, and they're going to be part of the drain on the welfare system. Today, the number's more like 13 million unemployed, and 4.5 to 5 million long-term unemployed. So long-term unemployed is really an issue.
And it just hasn't been coming down as a number.
No, and there's all kind of studies showing that the hiring, small businesses and medium-sized businesses just do not want to hire people who haven't had a strong employment history. They view them as damaged goods. So my point is, will the tapering, which you heard of last week, which would be the reduction of bond buying, will that begin at the end of the year? And it's anybody's guess, but basically Bernanke said if we get the unemployment rate down to 7, notwithstanding everything I just mentioned about the employment to population ratio, we're going to start to taper. So I urge you, seriously, to read and learn and watch as much as you can about the unemployment rate. That's going to be your trigger. That's going to be the trigger that's going to see rates go back to their historical levels.
Well, based on where you see the economy in here right now, and of course one of the things that we watch carefully as part of these webcasts is the Fed Philly 6-month leading index.
Right.
Is that's just not showing a whole lot of growth in here.
No, it's not. But you can imagine a situation over time as more and more people become discouraged. You can see the unemployment rate drop even though there's not a real improvement in the economy. So, it's anybody's guess. But my view is, we now have 2 people who are against more bond buying. That's a sizable number on that committee. And Jeremy Stein is very close, I think, to joining the group. So the next meeting will be critical. If they get 3 dissents or even 4 dissents, then we know there's even confusion in that great committee, the FOMC, who really runs, as we learned last week, Jay. If you had any doubts about the premier economy in the world, if you're worried that China's going to overtake you, it wasn't the Chinese bank that ruled the markets all over the world. It was the Federal Reserve Bank. We lost 5% of our equity values in our 401ks here, but the Chinese lost about 7%. Even though they had nothing to do with it directly. So,
yeah, and I think that was one thing you and I were talking about is by them creating all this havoc, is that a situation where the economies could slow down even further because of a lot of these movements, dropping wealth, all of those different things.
Are all negative, absolutely. The housing, we've seen some improvement in the housing market. Now mortgage rates are over 4%. Will that put a dent in it? All these things are going to have to play out, and we're going to have to wait and see how they do play out. But if you see housing starts dropping, if you see some negative effects of the talk of the bond buying to stop, I would think Bernanke would, retrace his words, come back on his words.
Yeah, because I think that what we're talking about here, Ed, is what is called risk. And certainly, I think that most of the community bankers out there would like to see interest rates go up. But at the same time, there's an impact in terms of the investment portfolio if those interest rates start moving up. And of course, then if things slow down and unemployment just sort of remains right where it is right now, is that most likely that would suggest we could have rates actually go down. So it's the risk of up or down. And I think that as we look at it, is that really looking at some selling, what I call taking some risk off the table, is always a worthwhile type of situation.
Yeah, you know, I'm certainly not you and don't have your expertise in the bond trading division of our firm, but it seems to me that you would have to admit, Jay, that the chances of a rate hike today are much stronger than they were 4 years ago, or 3 years ago, or 2 years ago, or 1 year ago.
It's all a matter of when.
Yeah, but the when is more pressing today. Would you agree?
And that's the reaction I think we're seeing in the marketplace.
I would think it would be prudent to take some of the, if you have gains, to start taking them soon, to think about taking them soon. Because you hate, what you hate to see is watch them evaporate before your own eyes.
That's right.
Yeah.
Well, thanks for joining me, Dr. Ed.
My pleasure.
This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.